in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures bouncing back as investors bet on Fed rate cuts following a cooler than expected jobs report. President Trump says he'll announce a new Fed governor and a new chief for the Bureau of Labor Statistics. And U.S. Trade Rep Jamieson Greer says Washington and Beijing are, quote, halfway there on rare earth flows. So let's take a look at where we stand futures-wise, because it looks like we might be in for a bounce back. Adriana calling Friday Freaky Friday, and you all know why. The S&P 500 was down 1.6%, the Nasdaq 100 was down 2%, and yields plummeted. It looks, though, like we might be in for a better session this Monday. There's lots to look forward to, perhaps even more Fed rate cuts. That's what it's all about at the moment, September 17th. Do we get a cut? Do we get even potentially a 50 basis point cut, like some in the market anticipate? Let's have a look at those yields, because we are coming back from Friday's drop, but not by that much. You see the 2-year yield up about 3.5 basis points right now. It is early going. And the 10-year yield up just less than 3 basis points. Don't forget that 10-year yield dropped nearly 30 basis points on Friday. So that's where all the action is going to be at today. We will be taking a look at what the market is anticipating. After all, there are some out there, including Adriana, who still see no interest rate cuts this year because they think consumer price inflation is going to see a boost in the coming data points. I do want to point to oil as well, of course, OPEC Plus putting in those extra barrels. It is putting a little softness into the oil market, but not by that much. WTI down about 1%. So let's get to some individual stocks to watch now. And Valerie Teitel. Valerie.
Good morning, Vonnie. Let's start with Boeing. There's been some news about the St. Louis factory having some strikes. We're seeing Boeing on the back foot, down nearly 0.5%. Now, note that this St. Louis the strike that's happening in St. Louis is a lot smaller than what happened over in Seattle earlier this year. So that's probably the reason why for the tempered stock move this morning. Let's move on to companies reporting today. The big one being Palantir. This is the data company, the software company that's highly leveraged to the defense space. We're already seeing some optimism, Vonnie, baked into the stock before these earnings. The earnings are happening after the bell later tonight, but the stock is already running up 2% so far in the pre-market. Lastly, I want to talk about some M&A news for those taking helicopters out to the Hamptons. Vonnie, Blade is under some speculation of an acquisition by Joby Aviation. That stock is jumping 20% in the pre-market trade. Vonnie.
Yes, I did notice that, Valerie. I have not been a client, at least so far anyway. Thank you for that. That's Valerie Teitel there in London. And in this hour, Lizzy Galbraith of Aberdeen joins to discuss President Trump's tariff playbook, and Skylar Montgomery Koning of Barclays joins on her dollar outlook. Now, most of President Trump's new tariffs will take effect later this week, right after midnight, August 7th. Aberdeen's Lizzy Galbraith writes this, quote, "We expect that the stagflationary effects of tariffs on the domestic U.S. economy will begin to build from here, presenting a challenging outlook for the Fed. We expect core inflation to increase over the rest of the year." And Lizzy joins us now. She's political economist at Aberdeen. And thanks so much for joining, Lizzy. Lizzy, does your base case hold regardless of what kind of tariffs we see on, for example, China?
So our base case incorporates an assumption of tariffs of around 40% on China, all things being said and done. And actually this 40% transshipment tariff that we're starting to see crop up after Trump's announcements last week reinforces our assumption that that's where the eventual level will settle. Now, US-China negotiations are ongoing, so there is, of course, some uncertainty there. And we do operate on a scenario basis for this. So we do have this 40% base case, but we do acknowledge that there are risks skewed both ways, both given the constantly fluctuating nature of US-China relations, but also the critical minerals leverage that the Chinese appear to hold over the US economy at this stage does give it more leverage than some other countries have had in their negotiations with the US. And that could pull tariffs lower eventually as well. But for now, we stick with our 40% assumption.
Lizzy, 40% is a whopping tariff. What does that do to US inflation, for example?
So we are expecting that US core goods inflation in particular will continue to creep up over the rest of this year. We're expecting it to become more material over the autumn and winter months. We, of course, have seen that impact delayed somewhat relative to our previous expectations. as we've seen tariff levels fluctuate so much and quite a lot of front running of good purchases delay that impact. But it does create a bit of a tricky combination for the Fed, particularly when you see it in combination with what appears to be a slowing jobs market as well, now that we've had that Friday payrolls report as well. Now, we're not expecting, sort of runaway inflation. We do think that the risks here are relatively contained, but nonetheless, we are expecting upward movement in goods inflation over the rest of this year. And that is, of course, something that the Fed has been very clear that it is taking into account when it's thinking about its decision making over the course of this year and into next as well.
Right, and this could very well present a big conundrum for the Fed at its next meeting. It does have, roughly 6 weeks till that September 17th decision has to be made. Nevertheless, we're not going to get that much more inflation data between now and then. What does the Fed do in this situation when the market clearly thinks, 4 out of 5 participants at the moment clearly think there's going to be at least one rate cut in September?
Yeah, it is, as you said, a very, very tricky proposition for the Fed. You're not necessarily going to have, all of the data that they would necessarily want to be able to make a decision like this. And Powell has indicated that, he is potentially more of in the camp of, let's wait and see. Let's try and understand how the changes in US policymaking are affecting the economy. But nonetheless, there is still pressure building for a cut in September as well. And we do think that jobs report that we got on Friday does make a September cut more likely. We have been in the camp of thinking that December has been more likely up until that point, because it would allow the Fed to have a better understanding of how all these different policies are affecting the US economy in greater detail. But it is that picture is somewhat shifting as a result of the jobs picture moving as well.
Lizzy, we are seeing many carve-outs. So, our Sean Donlan has written about this. There's about $1 trillion worth of goods that have been carved out with exemptions from these tariffs. Are you considering that at all in your playbook, in your base case, and what it might mean for inflation? Could it be material?
Yeah, one of the things that we think is going to be a core picture, part of the tariffs picture, is that it is somewhat constantly shifting. We're not necessarily getting to a point where we can say, OK, tariffs are now done, everything's stable. You are getting a bit of a shifting picture constantly, whether it's through sectoral tariffs being added, and therefore the tariff rate on some sectors potentially moving upward over time. And also, we're expecting more trade deals to come through that potentially lower the tariff rate for some of the currently affected economies. And of course, additional carve-outs could also be agreed over time as well. So we are expecting it to continue to fluctuate, even as we start to see a bit of a landing zone where we can understand the sort of the rough contours of where certain countries are likely to end up. But that doesn't necessarily mean that tariffs are going to be done and completely embedded on a totally stable level from the 7th. So that does mean that you do potentially get some shifts going forward, particularly for some sectors where we think that tariffs are still coming down the track, like pharma. Now, we know that the EU have got potentially a bit of a preferential deal there on some pharma tariffs, but we don't necessarily know the full picture for the rest of the world. And that could be a really important one when we're considering the overall outlook from here, as well as potential additional tariffs levied. We know that some extra inquiries are being conducted by the US Trade Representative at the moment. That could still result in a shifting picture over the rest of this year.
And Lizzy, just briefly, if you see tariffs being a considerable headwind to US growth over the next 2 years, there is, in your opinion, perhaps an offset. We might have to wait, but by 2026, 2027, there will be a support to growth. Can you give us just a little more detail on that?
So what we are saying is that for some affected economies like the Eurozone, as an example, they're currently, we are expecting a hit to growth as a result of the tariffs that they're going to be levied with from the end of this week over 2026, 25, 26, sorry. But because we're also expecting in the Eurozone increased defence and infrastructure spending to start coming through as part of the changes to the Eurozone's fiscal rules and as part of the increased defence and commitments that they've made through the NATO summit over the summer, we are expecting that actually we're going to see some support to growth as that money starts to move through from government commitments into the real economy from 2027. So we think there is support coming that will, over the more medium term, help offset some of these immediate impacts that we're seeing on the trade side.
All right, Lizzy, thank you so much for joining us this morning. That is Lizzy Galbraith of Aberdeen. Now to top stories trending on the terminal this morning. Swiss stocks getting hit today, nearly erasing gains for the year. That's on fears President Trump's 39% export tariff will dent profits there. Switzerland, known for its luxury watches, rich chocolates and banking giants, of course, is one of the US's biggest trade partners. More than 3,000 Boeing defense workers are on strike, walking off their jobs around midnight. The workers rejected a modified contract offer which would have raised wages by 20% and boosted retirement contributions. Union members built fighter aircraft such as F-15s. BMW is taking on Tesla and is going all in on its new electric vehicle offering. The German carmaker's flagship factory is set to produce nothing but EVs by 2027. It's staging a swift rollout of 40 new or updated models with high-performance computers. Coming up, Kugler exits. President Trump prepares to name replacements for the Fed governor and the fired jobs data chief in the coming days. More on that next. This is Bloomberg.
I have a couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who was I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
The exit of Fed Governor Adriana Kugler handing President Trump a sooner-than-expected opportunity to appoint someone who more closely aligns with his preference for lower interest rates. Joining us now from Washington is Bloomberg's Kasia Klimaszinska. Kasia, a very interesting development. Does this mean that the heat might come off Fed Chair Powell for a little bit if the president is, more focused on appointing a new governor?
Good morning. Thank you for having me. So indeed, even as President Trump has only one event on his schedule for today, this is lunch with Vice President J.D. Vance, but he will be very busy thinking about two nominations, the one that you mentioned, of a new Fed governor after Adriana Kugler announced unexpectedly that she will resign sooner than expected. Her term was about to expire in January, so I'm sure President Trump already had an eye on this possible vacancy coming up, but now he will have to announce the replacement sooner. And also because the term of the chair of the Fed, Jerome Powell, expires in May, President Trump might announce somebody now who will first get on the board and then eventually become the chairman.
So who should we be expecting to be in the mix? The same names that we've been hearing as a potential new Fed chair?
Indeed. So there are two Kevins, right? Kevin Hassett, who is now at the White House. He's advising President Trump. He's very much aligned with Trump. Several times he expressed his concern and his support for interest rates being cut. There's also Kevin Warsh, who used to be on the Fed. And there is also Treasury Secretary Scott Bessent.
Kasia, moving to the data statistician chief, how can President Trump have an impact on that bureau by appointing somebody closer to him?
Yes, so that's perhaps an even more surprising story. After we had relatively weak job data on Friday, President Trump announced on Truth Social that he's firing the head of this agency and he will pick a new one. We had a note from JP Morgan economist Michael Ferroli just yesterday saying that this is a very important development, that markets should perhaps pay even more attention to that than the Fed, that this agency being politicized is a serious concern. It might have impact not only on the economic data, but also on financial markets, given that BLS is producing a lot of data that is impacting the trading of dozens of assets every day. For example, inflation-linked treasuries are linked to CPI, which is one of the data sets that this agency is responsible for.
It's going to be some interesting days ahead. Kasia, thank you so much. That's Bloomberg's Kasia Kimishinska in Washington. Meanwhile, the trade talks persist with China.
They really focused on rare earth magnets and minerals. China has put a global control on the world. And so for the United States, we're focused on making sure that the flow of magnets from China to the United States and the adjacent supply chain can flow as freely as it did before the control. And I'd say we're about halfway there.
Joining us now is Brendan Murray, who leads our global trade coverage. So it seems to be all about the magnets right now. Brendan, how many more do we need if we're halfway there? What does that even really mean?
Yeah, he didn't put any numbers on the halfway there comment, but we do know that there's a deadline coming up here in the near term. August 12th is when the current ceasefire truce between China and the U.S. and the very high tariffs that they had on each other just a few months ago. And they came out of the meeting in Stockholm a week ago saying there were just some small technical details to work through. But here we are a week later, and if those were so small and insignificant, why aren't they resolved by now, and why haven't they extended that truce? So there'll be a lot of focus on the White House today and in the days ahead this week to try to understand what are the sticking points, if there are any, and why can't they get this, as Treasury Secretary Scott Bessent has said, maybe a 3-month postponement, kick this can down the road into November or so. Why haven't they gotten there? The other short-term deadline we're looking at is August 7th. That's this Thursday, when those tariffs that President Trump announced on Friday take effect for most major trading nations. There's some thinking that perhaps there are still a deal to be done for a country like Taiwan or perhaps Switzerland, which got hit with 39%. So there could be some furious deal making going on in D.C. Over the next couple of days.
For sure. And then the other question is that it seems that the heat is being turned up with the relationship with India. Indian Prime Minister Modi urging the nation to buy local goods in the face of U.S. tariff threats. What kind of a response should we expect from President Trump on that?
Well, President Trump, likes to escalate so he can de-escalate. So this is just the latest in a series of shots that each leader has fired across the other's bow. It's you could see a point at which they disagree so much, and the rhetoric gets so heated that President Trump takes the temperature down. But I think what you're seeing from India is what we're seeing from South Africa. It's what we're seeing from Brazil. It's these countries are saying, look, if you're going to treat us like this, then we're just going to take our business elsewhere. We're going to look for other markets to do business with. I think that's one of the key things to look for in the weeks ahead, is to what extent countries can try to step back from the U.S. market and diversify their supply chains elsewhere around the world.
Yeah, you mentioned South Africa, Brendan. It's actually stated and is looking for new relationships. This is going to change ties, particularly with global South countries. What else do we know about where South Africa might be able to boost its ties and replace some of those relationships that it had with the United States?
Well, there's the continent-wide free trade across Africa. So there are some thoughts that there could be some diversification there. But countries like South Africa and others that are in the BRICS are really trying to formalize some of these relationships, understanding that the U.S. is trying to sever a lot of them. So it's still, that's the big bet. President Trump thinks that they can't live without the U.S. economy. That's the leverage he has over them. And so they're going to be weighing up some difficult decisions if those tariffs take effect as President Trump has implemented for August 7th and starts to reshape trading flows around the world.
As you say, just 3 days away. Brendan, thank you so much. That is Bloomberg's Brendan Murray there in London. Coming up, Texas Democrats flee the state to block a redrawn congressional map. More on this and a look at what else is making headlines in your front page news. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, a Wall Street Journal exclusive on how China is choking supply of critical minerals to Western defense companies. China supplies around 90% of the world's rare earths and dominates the production of many other critical minerals. Next up, on the Washington Post, Texas Democratic lawmakers are fleeing the state to block a Republican redistricting push backed by President Trump. The walkout will leave the state legislature short of the minimum number of lawmakers required to hold votes. And on the New York Times, U.S. and Israeli officials float the idea of a, quote, all-or-nothing Gaza deal. With Israel-Hamas talks now at an impasse, American and Israeli officials appear to be sharply changing their tone by pushing for a comprehensive deal. Let's get a check on the markets now. We do appear to be looking at a positive day. We've had positive sessions across Asia and into the European session. Right now, S&P future is pointing to a gain of 0.7%. That's, of course, after the index dropped 1.6% on Friday. The Bloomberg Dollar Index relatively stable, fractionally lower. The 10-year yield bouncing back by less than 3 basis points. That plummet of 16 basis points on Friday, really something to watch. Of course, the 2-year yield was down 28 basis points, and that is up only around 4 basis points right now. Coming up, we're going to discuss currencies with Skylar Montgomery Koning of Barclays. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures bouncing back as investors bet on Fed rate cuts following a cooler than expected jobs report. President Trump says he'll announce a new Fed governor and a new chief for the Bureau of Labor Statistics. And U.S. Trade Rep Jamieson Greer says Washington and Beijing are, quote, halfway there on rare earth flows. Let's take a look at those markets as we inch ever closer to the open. Look at that green on the screen for S&P futures, Nasdaq 100 futures and Russell 2000 futures. That's, of course, after a blood red day on Friday. Adriana calling it Freaky Friday. In fact, it was that bad. The S&P was down, well, 1.6%. Let's not maybe get too carried away. The Nasdaq 100 was down 2%. But we haven't seen those kinds of declines in quite some time. If we take a look at bonds, the reaction is a little bit more muted today. We're up just less than 3 basis points on that 2-year yield, which dropped, remember, almost 30 basis points on Friday. So we'll see how that moves today. Obviously, repricing of Fed rate cut expectations built in here, but they're not being repriced today. We still have to, of course, see who the next Fed governor to replace Adriana Kugler is going to be. Also, what's going to happen with the Bureau of Labor Statistics. All of that to come this week. Let's get to some stocks to watch now, though. We'll go to London and Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with Boeing. There's word that the trade union at their St. Louis factory is going on strike. Those shares are on a back foot, down less than 0.5% this morning. The St. Louis factory makes their F-15s. It's focused on defense production, but the trade union there is one of the smaller ones at Boeing, hence the tempered decline in the pre-market. Let's move on to earnings. It's a quiet day-ish this week for earnings, but we do have a big one after the bell. That's Palantir, and we're also seeing some positivity baked into this stock already in the pre-market trade, up 2.2%. This is the data software firm that is tied mostly to the defense industry. They report after the bell, the biggest stock in the S&P 500 to report today. Lastly, some M&A activity. It is Monday. There is some chat that Joby Aviation is looking at a potential acquisition of Blade. The shares of Blade up some 19%. I think most in Wall Street might be familiar with Blade as they charter many helicopters out to the Hamptons. Bonnie.
Yes, indeed, Valerie. The summer isn't over yet. You never know. That's Valerie Teitel there in London. Barclays FX strategist Skylar Montgomery Koning writes this. The dollar bearish view is a narrative around the end of U.S. exceptionalism, but that narrative has failed to show up in flows or data. It's a fascinating take, and she joins us now in studio. Skylar, you say that this bearish dollar narrative is not showing up in the flows or data, but we have had a significant drop to the dollar. Are you saying that that drop is now perhaps complete?
I think what we see maybe is a little bit different in the near term versus the long term. So in the near term, Friday's data was pretty unambiguously negative. I think the market processed that well. We added on top of that the resignation of a Fed chair. So you now have questions around who's going to become, sorry, not the Fed chair, the resignation of a Fed governor. So you now have questions around who will be the next Fed chair, as well as the issues that you have around the BLS. So in the near term, certainly, I think you can look at tactical shorts in the dollar. I think longer term, though, we have one data print. Yes, the revisions were also negative, but it may be exaggerating the weakness that you see in the U.S. economy. Elsewhere, we haven't seen a lot of that weakness. So if you look at other labor market data, say layoffs, so claims or openings, those are still holding up at very strong levels. And at the same time, what we heard from the Fed last week was that it's both the supply and the demand of labor that matter, and those are coming down together. So they're really watching the unemployment rate. So it feels like it's a bit premature to price in almost 3 cuts this year for the Fed when you don't really know where that unemployment rate will go. We think it will only rise modestly. And at the same time, inflation is likely to rise quite a lot. And so we still only expect one Fed cut this year.
Yeah, Adriana doesn't even expect any. He says none and done still, for pretty much the same reasons. What are the flows showing if they're not showing that U.S. exceptionalism is over? Is it that, there's still a lot of optimism about the U.S. economy and about, the fact that the dollar is the reserve currency to the world? Or is it just that, people don't know yet?
I think the issue isn't so much around optimism. I think it's mostly that there's not a great alternative. And so there was all this excitement in the first quarter of the year around Europe and that they get more fiscal. You haven't had fiscal relief spread out beyond Germany. These other economies haven't decided to take on that loosening of the fiscal rule as a way to boost their economy because they're worried about their debt load. And so what you've seen instead is, this flow out of the U.S. into other regions that was expected. It just hasn't happened. You haven't seen broad flows out of U.S. equities. You haven't seen broad flows out of U.S. fixed income. And you're unlikely to see those flows if the data keeps holding up, right? Because it means that U.S. tech in particular is holding up the equity market there, but also U.S. earnings generally can outperform still. And it means that if the Fed stays where it is, U.S. yields are still relatively attractive.
So to phrase it in trade terms, because everything has to be phrased in trade terms, we're seeing ties broken, new ties being formed, efforts at new ties and so on the trade front. But you're saying when it comes to currencies, we're not really seeing the same types of relationship changes.
I think we had initially on Liberation Day seen a very large relationship change in terms of Liberation Day was taken pretty unambiguously as negative for the dollar. I think there are 2 big reasons for that. The first is there was a question over whether or not the U.S. administration was prioritizing U.S. growth. If you had such a negative U.S. growth policy come out, and then the second bit was around the U.S. was starting a trade war with the rest of the world. The expectation was the rest of the world would retaliate, and that would hurt U.S. growth much more than elsewhere because all U.S. imports would be affected versus Europe. It's just their exports to the U.S. that are impacted. What we've seen instead, though, is that these economies are willing to accept relatively high levels of U.S. tariff rates without retaliation. They're also much more open economies. The U.S. is the most closed economy within G10, and so a trade war that slows down global growth is more negative for them than it is for the U.S. And so we've now flipped to much more of a normal correlation, I would say, where when you had the European trade deal, it wasn't seen as a positive for Europe, it was seen as a negative for Europe and a positive for the dollar.
So in Barclays' view, what are the currencies that we should stay long and relative to what? I mean, is the euro going to suffer now?
Yeah, I think the euro certainly has really benefited as a dollar liquidity play. So there's not a lot going for it from a fundamental perspective for growth next year. And this year it is quite weak because you're coming from a place of stagnation and the negatives from growth from tariffs far outweigh any kind of fiscal impulse you could get that's more positive. I think, though, other currencies to look for are something like the yen. So there's a big fiscal premium baked in there now. That's maybe not as justified. You also kind of see a decay factor with those premiums. They've gotten a trade deal. That trade deal meant that we raised our growth and inflation forecast. That's also fed into the Bank of Japan inflation forecasts, which are significantly higher. You are actually seeing inflation that's being driven by wages rather than kind of more transitory one-off factors. And so that should allow the Bank of Japan to hike in relatively soon. So we expect the next hike now in October. And that means the Bank of Japan is hiking as the rest of DM is easing. And that's very supportive for a currency, especially one that's a safe haven.
So then should we expect renewed appetite for the carry trade again? And are we back to where we were?
I don't know so much on the carry trade. I think the carry trade makes me a little bit nervous because you need 3 fundamental things, right? You need interest rate differentials, you need positive risk sentiment, and you need low volatility. Some places you do have interest rate differentials that are significant enough, but that gap is certainly closing with a lot of G10s easing. And I think the issue really is whether you get that rise in volatility or risk sentiment coming off because yes, we're excited that tariff rates aren't as bad as they could have been, but the market's also looking for the Fed to be supportive this year. And as we saw on Friday, if you get poor data, then that's not great. And also if you get the Fed not cutting as much as the market expects, it creates some wobbles as well.
Now, do we get a lot of volatility, Skylar? Right now, the DXY is at 98.79. We're talking about, 115.71 versus the euro. Do we see, big movements there? Many big figures, for example, for the euro?
Yeah, I think for eurodollar in particular, we do have some near-term weakness. So 117 for eurodollar is what we're looking at near-term. But then further out into 2026, we have this kind of gradual fall to 113. And I would say here as well, what you've seen is that you've had a lot of front-loaded weakness, right, in the dollar. So the first half of the year, you saw quite a lot of that priced in, and you saw more negatives priced in than positives, as in it was an asymmetric reaction function, where, for example, something like fiscal, which could be seen as positive because it boosts growth in 2026, was taken as a negative because Section 899, which isn't even in there anymore. And so that means that even to kind of get more to a fair value level, you'd expect some kind of dollar appreciation, where even post the move we had in yields on Friday, fair value on something like terminal expectations is closer to 112.
Wow, 112 all the way down from 115. Skylar, thank you so much. We'll be chatting with you again before all of that happens, no doubt. That is Skylar Montgomery Koning of Barclays. And now to other top stories trending on the terminal this morning. Swiss stocks are getting hit today, nearly erasing gains for the year. That's on fears President Trump's 39% export tariff will dent corporate profits. Switzerland, known for its luxury watches, rich chocolates and banking giants, of course, is one of the US's biggest trade partners. Berkshire Hathaway shares are lower pre-market after reporting that it took a $3.8 billion impairment on its Kraft Heinz stake. It reported a $344 billion cash pile for the second quarter. That's the first time in 3 years that the war chest has shrunk. Just a little bit. BP says it made its biggest discovery in 25 years. It found a 500-meter column of oil and gas in deep waters off Brazil. The discovery is a boon for the UK oil major as it seeks a turnaround after years of underperformance. Coming up, President Trump prepares to name replacements for Fed Governor Adriana Kugler and the chief of the Labour Statistics Bureau. More on all that next. This is Bloomberg.
I have a couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who is I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
Fed Governor Adriana Kugler's resignation giving President Trump an open spot for an appointee of his choosing faster than anticipated. Joining us now from Washington is Bloomberg's Kasia Klimaszinska. So Kasia, we were all focused on the Fed chair, but now perhaps we should be focused on a different seat. Will it take the pressure off Fed Chair Powell, at least for a few months, if President Trump gets to nominate somebody to be governor?
Good morning. Indeed, finally, President Trump has a chance to make his mark on the Fed in his second term. He has been criticizing the Federal Reserve since he became the president, since he returned to the White House, attacking especially Fed Chair Jerome Powell personally for not cutting interest rates fast enough. Now, Chair Powell's term doesn't expire until May, but now with this resignation from Adriana Kugler, President Trump has a chance to pick somebody new, add them to the board, and perhaps later promote them to the Fed chair in May.
Now, Kasia, the data statistician that might be appointed by President Trump, how much can he influence the collection of statistics by, putting in somebody that's closer to his interests?
Indeed, that's a great question. That's an even more interesting, more surprising story. On Friday, we had those relatively weak numbers about the U.S. job market, and as a result, President Trump went to Truth Social and he said he's asking to fire the head of this agency and he will pick somebody new. That's obviously a shock. This agency, BLS, is considered a gold standard, highly regarded here in the U.S. and around the world for putting out reliable, fast, accurate numbers. Now, a lot of people, economists, former heads of this agency say that this one change should not impact much, that the army of statisticians and economists that work there, that they will continue to produce reliable numbers that are really crucial for financial markets around the world.
I think that is certainly the hope, at least. And then let's move to trade, because we had, high hopes for Stockholm, but now we have the USTR, Jamieson Greer, saying US-China talks are, quote, about halfway there on rare earths. What does that mean for overall talks with China?
Indeed. So we are still waiting for President Trump's decision on that. Remember, last week on Thursday, the White House unveiled this huge list of new tariffs for all the trading partners around the world, except for China, and that's because those talks between the U.S. and China are ongoing. Last week, Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer met with their Chinese counterparts in Stockholm, as you mentioned. And then the Chinese side came out and announced kind of a success, saying that this tariff thaw or truce has been extended. But then Treasury Secretary Scott Bessent and Jamieson Greer said that the decision has yet to be made by President Trump, and we are still waiting for this announcement. But those comments from Jamieson Greer yesterday were very interesting, very insightful. He kind of said that the U.S. and China are halfway there, implying that the magnets are not flowing fast enough to the U.S. So the U.S. wants magnets or rare earths from China to be able to produce home appliance, missiles, a lot of products, and it looks like they are not satisfied with the supply yet.
All right, Kasia, thank you so much. That is Bloomberg's Kasia Klimaszinska in Washington, D.C. Let's turn to oil now. Prices taking a little dip this morning as investors assess the decision from OPEC Plus's production hike and the possibility that the group may now pause increases. Joining us from Dubai is Bloomberg's Anthony De Paula. So, Anthony, as I say, we're seeing just a little softness there in an oil market that's already pretty saturated. Why not more, given that we're seeing quite a lot of barrels come back to market now?
Yeah, good morning, Vani. Oil is pretty stable. We are into the red now. We were in green here in Dubai this morning, but we're still around that $70 mark, which isn't bad for oil. And really, it's not a decline that would indicate 500,000 barrels of new production coming online from OPEC. These decisions were forecast by the group. So there was some reporting from Bloomberg this weekend that they did expect to go ahead with that. And coming out of the last meeting a month ago, when OPEC made a similar increase for August, the decision this weekend was for September volumes, it seemed pretty much likely that they were going to go ahead for the second straight month of that same size increase. But what we're seeing is a really market that's really benefiting from high demand. So we've seen a lot of good summer demand from transport, so transport fuels like gasoline, diesel, because people are driving around going on with their vacations, and also jet fuel, again, as people fly and go to different destinations. So we've seen that demand really holding up over the summer months, and that's kind of been the surprise, that we haven't seen demand waning. We haven't seen the oil market crumpling a little bit more under the weight of this added OPEC plus supply, which is kind of what you would expect. But as we get that supply coming on in August, coming on in September, we may be going into those more shoulder months as demand wanes kind of into the third and fourth quarter, Vani.
For sure, and OPEC Plus seems to be keeping its cards close to its chest on what it's thinking for a next decision, Anthony. I mean, is it possible that it could continue to add more barrels back? Are the likes of Saudi hurting financially? Would they need that?
Yeah, I mean, for sure they could continue to keep adding things back, because OPEC Plus at this point is cuts upon cuts upon cuts. So what they've done now is rolled back one group of voluntary cuts that a group of 8 countries made. There are other levels of cuts that OPEC still has to reverse as well, too. So if they see the market continuing in this strong fashion, they could add some more oil to the market. OPEC is looking at the benefit of gaining some market share. A lower price will also hurt some of their competitors. However, OPEC has tried to play that game before, and they weren't able to price competitors like U.S. shale out of the market. The U.S. shale producers bounced back and are still a major player in the market. But OPEC is looking to gain back some market share. They could add back some more. They could even take some more off of the market if we see that weakening through the end of the year, Vani.
Anthony, thank you so much. That is Bloomberg's Anthony De Paula there in Dubai. And one stock we're keeping an eye on, Boeing, down about 0.5% now in the pre-market. More than 3,000 of the firm's defence workers are set to go on strike. In fact, they're on strike this last almost 6 hours now. That's since 1996 has there not been a strike like this. They rejected a 20% pay rise, among other things. Boeing says it's ready for the strike with contingency plans in effect. For more, Bloomberg's managing editor for space and aviation, Benedict Kamel, joins us now. Benny, what is the appetite among union members for a strike? We did see the last time, back in 96, a 99-day strike. Could it go even as close to that long this time?
Well, it looks as if this time they are really willing to go to a strike. In fact, as you said, they have. And it was a bit of a surprise. We came into this a week ago. There were preliminary conversations between management and the unions. And then we thought that they might use the week that just ended to get over that hump. And that clearly has not happened. So we are now in a strike scenario, first time in almost 3 decades. Whether it'll go to the 99 days that we had last time is anyone's guess. I would probably think that they will get to an agreement sooner rather than later. Boeing can probably afford a little bit more patience here because this is a business that is much smaller than the one that went on strike late last year. People will remember that the civil aviation business that went on strike last year. That was more than 30,000 people, and that really ground those operations to a complete halt. So that's not quite as dramatic this time. So Boeing might be a little bit more casual about it now and might feel that they have the cards in their hand. So we'll have to see how the next rounds go. We don't know yet when they will join them, the workers and management. So it'll probably happen sometime this week. But at this point, the status is that the workers have walked off and they're on strike right now.
Yeah, CEO Kelly Ortberg saying we're looking at about 1/10 the size of last year's civil business strike. And so obviously, you know, that would be the company line anyway, right, to play it down a little bit. But I am curious, they manufacture the F-15 in this department, the T-7 training jets, missiles, munitions. Will there be any pressure put on the company to get this sorted fast?
Yes, I think the longer this drags on, the more pressure will build. This is the playbook that we saw on the civil side last year as well. At some point, you will get a mediator coming in. At some point, you will see the government come in and look at what they can do to facilitate things. This is a less visible part of the business. They make fighter jets, they make training jets, components for some civil products, but it's not as visible as the civil aircraft that we all use on a daily basis, and therefore it won't have as dramatic a ripple effect across the entire company. As you said, Kelly Ortberg, who really walked into that strike last year, he is a little bit more casual about it. Yes. So this week will probably bring some movement.
All right, Benny, thank you so much. That is Bloomberg's Benedict Kamel there in Berlin. This is Bloomberg. Now, for a look at what's ahead this week, we get PMI and trade balance data coming on Tuesday. Earnings continuing apace with AMD reporting Tuesday, Disney, Uber and Lyft on Wednesday. And a Bank of England rate decision comes on Thursday. I do have to say we have to get through Monday's trading session before we get to all of that, though, and it's going to be a fascinating one. If you look at S&P futures, we're seeing a big bounce back from those big declines Friday. It was a 1.6% drop, don't forget, for the S&P. However, we're not seeing quite the same repricing in the bond market. Will the bond market tell us what the Fed's going to do in September today? We'll see. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.